So what I'm going to, because we have a group, this is a great panel for this particular topic, and because we have such a diverse group, what I'd like to do is ask each of you, most of you are well known to the members of the audience, but I'd like to ask you to introduce yourselves not only with your technical qualifications, but talk about, from a contextual point of view, where you fit in the industry, so that as we have this discussion, I think people will be able to sort of color it in a little bit better. And Paul, why don't we start with you?
I'm a lawyer with the OSC Compliance and Registrant Regulation branch. I've been there for about 2 years, and before that I spent about 11 years in the Corporate Finance branch. I am one of the lawyers who's been involved in the recent suitability review of PMs and EMDs that Howard mentioned this morning. Before I begin, I have to give the usual disclaimer. When Howard speaks, his words do represent the views of the Commission. They made it very clear to me that that didn't apply to me. So I have to make it clear the views being expressed are my own and do not necessarily represent the views of the Commission or the staff of the Commission. Sometimes I think they should represent the views of the Commission, but I can talk a bit about the sweep, or if we want to do introductions first.
Let's go with the introductions. By the way, Paul and I were classmates at University of Toronto Law School. We graduated almost 20 years ago, embarrassingly. Let's move on.
Yeah, hello, my name is Vipool Desai, and I'm a CA and CFA professionally, but I've only had one career for the last 20 years, and I've been a compliance professional. So I started my career at the IDA, which was a predecessor to IROC. Excuse me. And after graduating from the IDA, I worked for some certain Canadian banks. I ran compliance for the Canadian operations of an international bank. I then moved on to doing some consulting. I consulted to a national firm that was assembling 4 large firms to develop into a national firm. I'm sure some of you folks can guess who that was. And then in 2007, I did something very radical for a compliance officer. I went out and started a business. And ERA Compliance Support is a very unusual offering. What we are basically is a compliance department. I've assembled a team of people, and we act as a compliance department for independent firms. And the reality of our industry is that it's very hard to find an EMD with more than 15, 20 people. So when you have a small firm, the CCO tends to have another job. They tend to be the CFO or the CEO or the head marketer. And the problem with that is they don't have the time and attention to focus on compliance issues, and they may not have the experience. So we've basically built a team of people to support that individual.
I'm Marsha Gerhart. I'm counsel at Borden, Ladner, Gervais at the moment. I have about 15 years of experience in the registrant regulation and compliance area. 10 of those were in the Ivory Tower at 20 Queen Street at the OSC. Then I left after 31103, working on that for many years, to go back to private practice to see what 31103 looked like in the real world. Have been working with registrants for the last 5 years, and in amongst those 5 years have been a director at the EMDA, seeing what it is like, not only from the individual registrant perspective, but from the whole exempt market industry, and I think that's been a huge bonus to my experience and the advice I give to registrants.
So basically you set the fire and then you moved across the street to help put it out.
A little bit of I don't know if you call that cradle to grave. I don't know.
My name is David Gilkes. I hate to say it, but I'm the oldest one here. I have 30 years of experience in dealing with financial industries. I worked for many years with Howard Wetson at the Competition Bureau, specializing in regulated and financial industries. Then went to work for Deloitte & Touche for a number of years in their forensic group. Then went to 20 Queen Street, worked with Marsha on developing 31103, and like Marsha, helped to light the fire. Then went out and was consulting with another consulting group, and now with North Star Compliance and Regulatory Solutions. and we help companies get registered, stay registered, put in their compliance policies, and if they get into a ditch, we try to pull them out.
Okay, as I just alluded to, I am a lawyer, and I can't really figure out if it's in spite of the fact or because of the fact that I'm a lawyer that I find myself on almost a daily basis completely mired in the vagaries of regulatory issues. But that doesn't mean that I think that there are easy answers, easy solutions. In other words, just because I pull my hair out sometimes at trying to understand whether I'm compliant doesn't mean that I think that, and I'm not just saying this because Paul's sitting here, it doesn't mean that I think that the OSC or other regulatory bodies have an obvious, action that they could take that would magically make everything go away, because they're smarter than that. And so what I'd really like to get down to in the discussion today is hearing, I don't want to say both sides, but both sides, explain from the two sides of the canal what it's like to grapple with these issues. Because our firm is a PM and an EMD, and so we have the same issues that any of you that are either EMDs or issuers here, some of you are both, which is one of the things we'll talk about today. Every day it comes up, and it seems to all center around the idea of suitability. Now, of course, you can't measure suitability without first having gone through the know your client and know your product phase, because when I explain it to a client, I talk about a three-legged stool where the three legs are interdependent. The stool staying aloft requires that all three legs be there. And this is a general question, but I wonder if each of you could take a stab at discussing this interdependence between know your client, know your product, and suitability, and how we can't look at any one of them, although we're going to try afterwards, independently of each other, because we have to see it holistically to understand what the problem is. And in this case, I do want to start with you again, Paul, because I want you to say, of course, from your own opinion, and not representing the commission, how you see this problem, especially because you've just finished the sweep that was not small.
Okay. Well, first of all, I'm going to say what KYC is not. It's not simply determining that the client is an accredited investor. Determining whether the investor is eligible to purchase under the AI exemption, and determining whether the investment's actually suitable for that client, they are different questions. And I think most registrants understand that, but unfortunately we have had to have that conversation with a few firms. Similarly, suitability isn't simply how much you can afford. It is meant to be an exercise where first the registrant needs to know the client, first there's the gatekeeper KYC elements, which is part of the registrant's obligation to sort of help maintain the integrity of the capital markets and perform things like anti-money laundering checks, identify whether the client's an insider or not. And then there is the client-specific KYC, or the investment needs KYC, which is understanding the client's financial circumstances, investment needs and objectives, time horizon, risk profile, and then making a determination as to whether the particular investment is suitable or not. So the firm needs to know the client and know the product before the firm can determine if the investment is suitable for the client.
David?
He's just described everything that you need, which is client due diligence and corporate due diligence and KYP. I don't think are the same thing. Corporate due diligence, determining whether or not the company exists, whether the company has a good business model, whether the company has solid management, is not something that you would present to your investor client. To your investor client, you're going to be presenting the benefits, the risks, the fees, the costs of the product, the tax implications, and whether or not that product works for you. But before that product is on your shelf as a dealer, you have to do corporate due diligence. You have to be sure that that firm is there. So you were referring to a three-legged stool. I think it's actually a four-legged stool. Before that product's on your shelf as a dealer, you have to be confident that that's something you want to deal with.
So Marsha, deal with, you used use the A word, advice, because basically in the end you're going to give advice to a client based on, I understand, what your objectives are, what your constraints are. I understand how this product works, and I think that they fit like Lego. At what point are you crossing as an EMD into the world that you're not supposed to be in, which is giving advice as opposed to making recommendations? How do you deal with that with your clients?
You just hit the $64,000 question in developing 31103, and
Yeah,
that takes us way
noticed.
back to the fair dealing model, and should we have one category of registration? Because every dealer's giving advice, and not necessarily every PM is doing dealing component, but sometimes that happens. So that's actually a topic for a different day. What I will add to it is I don't think it's a four-legged stool, David. I think it's a five-legged stool.
Oh, here we go. It's like a contest.
And I think it goes to your question as well, David. There is the conflicts of interest issue that has to be brought to the table in conjunction with knowing your client and knowing the product itself, knowing the issuer, knowing the background, being able to describe it, and then looking at your own situation as a registrant and saying, I've looked at the KYC, I've looked at the product, I think it's suitable for this person. However, there is a conflict here because we are the manufacturer, the advisor to the product, and the distributor of the product. And that takes us to a whole other level of analysis in assessing suitability.
Yeah, Vipool, maybe you can speak to that a little bit, because before someone ends up in Marsha's office, they're getting registered. and
Absolutely. I'm going to simplify things a little bit and bring it back to a three-legged stool. So by definition, suitability is a three-part question. Part one is you need to know your client. That's KYC. So what are my client's needs and expectations? The bottom line is when you're selling to a retail client, you're selling expectations, you're selling hopes and dreams. So you need to understand what is reasonable for my client to expect, number one, and what are their needs, I should say. And that's usually broken down in two things. Number one is risk tolerance, the other is investment objective. If you're selling a fixed income product, you also want to add to your risk of capital and risk of timely payment of dividends or interest or whatever. So that's know your client. And once you have that, then you need to know your product. And that's the full analysis, making sure your client isn't a scam, making sure that it makes economic sense, making sure the structure they put in place is reasonable, all that other stuff that they throw at you in the guidance. But the bottom line is that know your product also has to be broken down into two very important questions. What's the risk of the product, and what's the investment objective? And the third part of the stool is where you match the two. So where your client's risks and investment objectives match that of the product, then you have suitability. That's the classic definition from my perspective.
So, Marsha, you just mentioned the idea about a conflict, and of course the conflict is most apparent when you have an issuer EMD. And I think I can speak for the issuer EMDs in this room that when 31103 was being debated, you didn't run to the OSC's office and say, please force us to become EMDs. And yet, that's exactly what happened. And so you can't blame an issuer for becoming an EMD because they want to sell their own product, but doesn't it result in this kind of outrageous situation where you go through the know your client, you go through the know your product, that part better be easy, by the way, if you're an issuer EMD. The know your product part should be pretty quick. And then I always think, boy, they must feel very fortunate that every time they shake that magic 8-ball, their own product seems to be the answer. So talk about that a little more, please.
Well, that is the challenging issue in the discussion about conflicts of interest. Is it possible to be the manufacturer, portfolio manager to, and distributor of a product? And I personally, Marsha P. Gerhart, think it is. I think the regime is set up to accommodate that because it's not an evil model. It is something that we encourage people to do. We want to create innovation, entrepreneurship, and often that has to be one person or one entity doing the whole thing. The kicker comes in making sure that the disclosure is appropriate, that the conflicts of interest are properly identified, are properly disclosed to the client and discussed with them and are taken into Vipool, the suitability assessment as well. And I'm going to mention the nasty fiduciary duty concept out there, because that's part of it. It's saying, is that possible? Is it possible to really be able to make a recommendation to your client that's in their best interest, that is suitable for them, when you have this inherent conflict of interest because you are all three things? And I do think it is possible because of the regime set up to disclose it, to make the assessment, to advise the client. The client is there. If the client didn't want to have any part in the decision-making process, they'd have a discretionary managed account, presumably. They wouldn't be having a non-discretionary managed account. They wouldn't be coming to someone for advice and talking to them about their own knowledge, their own situation, their own hopes and dreams, and being part of the decision.
You're chomping at the bit?
This is a typical mercantile conflict. You go to a Ford dealership, you can only buy a Ford. You go to a Chrysler dealership, you are only buying a Chrysler. So this is not unique to the securities industry. And at the end, as Marsha's just alluded to, there are safeguards in the rules. You have to deal with your clients honestly, fairly, and in good faith. That requires doing a suitability analysis. That requires making sure that you do all the things that are required to protect investors. So I don't think that that is an inherently bad thing at all, and I think it's natural in a capitalist society.
So, David, are you analogizing EMDs to used car salesmen?
Well, it was said that if you couldn't sell used cars, you'd sell securities.
The comment I would make on this issue, the usual disclaimer, is I think you have to remember there's a wide variety of EMDs and EMD business models. I think we did a notice a few years ago, and I forget whether it was 7 or, but there's 8. But there's a lot. It's such a broad category, and I think the potential conflicts or actual conflicts when you have the EMD is selling either its own product or related or connected issuer product, they're heightened, and I think that it sort of behooves the EMD to have additional compliance systems and policies and procedures to make sure that it is thinking about like potential other investment products when it's doing a suitability analysis. I don't think it can make a suitability determination for a client and only think about its own type of product. I think it needs to make that determination and perhaps explain to the client that maybe 100% of your net financial assets in my high-risk, illiquid product isn't suitable.
Can I just make a comment here? I think product manufacturers love their products the way that we love our kids, in the sense that they're blind to any imperfections. And just because our kids are not all going to grow up to be hockey players or, I don't know, movie stars, whatever, not every product is going to outperform. And so I think if you're an EMD that's also a manufacturer, I disagree a little bit with Paul. I don't think you should be going out and offering your competitors' products. But I think what you should be doing is taking a close eye at your offering. And sometimes there's a process where you have to get on the dealer's shelf and they beat you up a little bit. They look at your offering, they put you through a due diligence process. It's embarrassing, but it's helpful as well, because what it allows you to do is to look at your offering with a clear set of eyes. So I think that if you are a manufacturer EMD, rather than having anything in the rules, I think it is to your benefit to look at what you offer and be very honest.
So rather than the Ford dealer saying you should go buy a Chev, the Ford dealer might say you shouldn't be buying a car. So that might be the sort of thing that you would expect. And this is one of those cases, in my estimation, where cover your ass and good business actually meet each other, because it's very short-sighted to take a ticket, knowing that, let's say they tell you, well, I might need liquidity in the next 2 months, and you've got a 5-year private equity deal. They are going to pick up the phone. It's not that hard to find Paul and his associates, and it's just bad business to invite that sort of activity if you knew it was unsuitable on the way in. But what I'd like to do is get into some hot button issues specifically regarding the KYC process and the Know Your Product process. And Paul did mention earlier that KYC is a lot more than just determining whether your client is exempt. But I'm sure you would agree that at a bare minimum, you must determine that your client is exempt.
Absolutely.
So, and that's actually not as easy as it sounds. I mean, you can, for me, the hot button issues are the definition of financial assets. I cannot possibly be alone in having, it's almost like every client is the exception to the rule, and I have to go back and sit down and figure out which are the financial assets and how are they valued? Do they have to be public? Do they have to be liquid? What happens if, what is real estate? Does it matter if real estate is owned by a corporation? Like, it's kind of odd to me that someone who owns a $3 million apartment building in their own name is not accredited, but someone that owns a $3 million apartment building in a numbered company is accredited. I don't think that the OSC decided that that was how it should be, but that's the effect. So that's an issue. Whether people have to be identified in person is another issue. If I know that this person exists and we go through the whole money laundering, et cetera, and I'm registered in BC and I'm resident, or my firm is resident in Ontario, do I have to have them go to a notary to actually get their ID notarized? And what if they live in the middle of nowhere? The biggest issue would be, and I'm going to open it up after this, is the definition of risk. I think that a lot of us operate under what is potentially a misconception that you must check off high risk if the product is exempt. When, to my knowledge, the Court of Appeal has said that as long as you both understand what you mean by risk, it doesn't matter what you call it, as long as you both understand what high risk or medium risk or low risk means. And so that's a lot of different issues, but maybe each of you could take a little bit of time because these are incredibly important.
On the question of risk, one of the practices that we've done at North Star is when we build KYCs, we put in a definition. We put in that low risk means the following, medium risk means the following, and high risk means the following. There's no misalignment between the dealer and the investor. They know exactly what's been told here. So you can lose all your money, you could lose part of your money, or you're in a situation where you can't lose any of your money. So that's clearly defined. The other thing we do is we also go through investor knowledge, and again, we put a definition. What is poor or novice, what is good, and what is excellent? And the same type of thing to make sure that people are on the exact same wavelength between investor and dealer. I think that we have found that that's been very good to help our our clients, who are lots of them are exempt market dealers, and determining proper KYC and next step to suitability.
So to that end, I'm going to certainly ask you all to speak about others. So Paul, why is there not a standard form KYC as an absolute minimum that is issued by a regulatory authority?
Well,
in your opinion?
Part of me thinks maybe there should be. I think we've always been a bit cautious about proposing our own KYC form, in part because a proper KYC analysis, it is hard to reduce to a form. It is meant to be personal to the client, to understand the client's investment needs, objectives, time horizon, etc. So I think there's probably been a concern that given that it isn't a sort of mechanical box-ticking exercise, it is meant to be a personalized process. That being said, though, I do think checklists and forms can be very useful as a support for a proper KYC process. I think we're considering that. I think IROC is also considering something along those lines. So part of the reasons we did the KYC suitability review in part was to engage with registrants and to further our own sort of understanding of what industry practices were. And we saw some very good examples of KYC forms and supporting documentation, and we saw some not so good examples. So I think we are going to sort of take that information, and that will, as Howard mentioned, that we should be putting something out in a report this fall.
Yeah, because to some people, of course, KYC is a form, and to other people, KYC is a process. So it depends, of course, how you do it. Now, Vipool, you see this every day.
I'd like to add a little bit of color. First of all, I think I agree with Paul here. When you look at the really complicated issues in compliance, they're not rules, they're concepts. So what is the business trigger? Or what is suitability? Or what is fair dealing? Or what is proper disclosure? Well, maybe disclosure we can get away with. But the really hard things are the concepts. And I think what regulation is saying is we want you to be aware and we want you to be a little bit scared when you go out there and you ask people for money. And so prescribing a suitability obligation or a form for every single business and every single product, and I agree with Paul, is a bit of a risk. Years ago, the IDA, IROC currently, I believe they still have that, they have a form in their CPH, Conduct and Practices Handbook, that firms were using as their KYC. Now, the funny thing about that form is it was really developed in 1974 by committee. So in other words, IROC firms were using a form developed 40 years ago by a committee to address their KYC obligations. And I think one of the things that is probably good for our industry as we start professionalizing the industry is not looking for supports or not looking for safe harbors, but being able to say, yes, I'm confident enough to deal with my clients. And I know what the smart questions should be when I meet with my clients, what I should be finding out about them.
Okay, so I want to ask a question, and Marsha and Paul, I want each of you to give a one-word answer. We'll see if it's the same. Do you have to identify a person either in person or through some sort of notarized document?
Yes.
I'm going to defer to Marsha's greater.
I mean, like, is that, well, let me ask the audience, is that obvious to you?
It's,
Okay, I mean,
it's required under anti-money laundering that you have to see them in person or have a notarized document. So it's not securities legislation. Securities legislation, you just have to verify the reputation of the person that you're dealing with, and that usually is having a photo ID, but it's anti-money laundering. You have to have photo ID.
Use a credit file as well as a check drawn on a TD bank.
No, you still have to have a piece of photo ID. You then verify it by having those other tests. So if you're not meeting a person in person, if you're not meeting a person face to face, you have to have a piece of photo ID, and then you have to have those other two pieces.
Okay, so someone walks in my office in person with a photo ID. How does that prove any more than over the phone that they are that person? Well, I don't, this is not entirely abstract, this question.
Well,
Well,
no,
I think-
you can see them.
Yeah, okay, so they're the person that's on the ID. Do I now have to verify that the ID is legitimate?
That's not the single item for identification, though, or KYC generally.
Well, they have the hydro bill too. I mean, where does it go?
You go from there to let's take a standard form.
Right.
And investment knowledge, financial circumstances.
I mean, all I'm getting at here is the concept of...
Is this a real case, David?
Yeah, I know. All I'm getting at here is surely there is an enumerated set of ideas that are binary and that could be listed as a checklist.
Yeah, actually, Stephen, I just want to pick up on a point that was made previously. The problem with being a dealer is that you're subject to legislation from different parties. So you've got the feds coming in with anti-money laundering regulation. You've got Paul and his team coming in with suitability. And, you have, many firms have old KYCs. They leave one firm, they join another, and take their old KYC with them. And they have funny things on their form, asking for the SIN number and such. Unless they're, preparing T5s, then there's no need for that. But in any event, I want to address this issue of identifying who you should be. And this is specified under federal legislation. And the difference between the feds and the Ontario Securities regulation is that the feds are very specific. They tell you exactly what you want or what they want, and if you don't follow their rules to a T, then you're offside. So they're very specific. They basically say that anyone who has authorized trading on the account needs to be verified. If it's an active business, no more than 3 people. And then it goes on to say you verify either in person or through an agent. You meet the person, you get acceptable photo ID or acceptable ID. You verify their appearance and you verify their signature. So what happened then is the banks went back to FinTrack and they said, look, this is a real pain because we deal with tons of clients, and we need an easier approach. So, you know, very honestly, I think the banks had a tremendous amount of influence in coming up with an alternative verification procedure for anti-money laundering. And what they basically said is you've got to pick 2 out of 3. So one is you get a guaranteed, doesn't have to be notarized anymore, but a guaranteed photocopy of acceptable ID. 2 is you clear a check through a Canadian deposit-taking institution, and it's got to be a check, it can't be a transfer. And 3 is you verify that that name is on a public database. And normally, for most people, the only database that we're on is that's accessible is a credit bureau. So basically, that's the rules, and it's very specific. Now, what's
Right.
happened is the OSC's come out and said, well, if it's a corporation, you need to document information on, identify who your beneficial owners are. And I think they borrowed a little bit from AML regulation, but I believe that's a different matter altogether. They're just asking you to use good common business sense in understanding who the beneficial owners are.
Okay, I want to come back up and get a little more abstract, but I'm going to ask a skill testing question and let everyone think about it. Say a corporation comes to you and they have 4 shareholders and they want to invest $149,500 into an exempt product. How are they accredited? I'm just going to leave that with you. It's a problem that I have not yet solved, so there's a prize. We have some books, actually, if you can come up and give an answer to that question. I don't know the
You could
answer.
lend them $1,000.
Sorry?
I'm playing it like
So I want to talk now about know your product, and it's funny because I'm not going to ask whether you have to meet the portfolio manager of a hedge fund in person. We'll leave that one alone. But what does know your product really mean? How deep dive does due diligence have to be? In the absence of a prospectus, I suppose part of, whatever disclosure there is, we have to increase our knowledge about the product by finding out a lot more than just whatever the offering memorandum or other documents say. And maybe you could speak about, in general, how deep do you have to go and what is it that you're trying to protect against? Is it against fraud? Is it against loss? Is it against loss in excess of what you think the risk profile of that type of strategy is? This is a very open-ended question, but I don't know that it's obvious how deeply we have to go in order not to be later on said to have not done our job in that respect.
I think for most people, you can start off with all the things that you've said. You want to find out about management, about the product, about the business model, about the financials. Does it make sense? One of the factors will be how well do you know the people. Some people will know the people with the issuer, and that makes a difference. But the one thing I think that you are obliged to do is that if you are looking through, doing your due diligence, and you're looking at something, and it makes you go, you have to satisfy that. You can't have a in your analysis. You have to be sure that you are comfortable with everything. And the one thing I think that a lot of dealers are probably reluctant to do, but they need to do, is when you get to that point where you cannot resolve that question, you don't put that on your shelf.
I think that's actually going back to the comments that the M&P people did on the due diligence and the 3 points that they said, which was, I think, do good work, document everything, and trust your instinct.
So Marsha, let's say that someone is involved in selling units of an LP, a private equity LP, that it's got call it 3 to 5 years. Does know your product extend post-purchase? Should I be able to pick up the phone a year later from one of the purchasers saying, how is that product doing? And should I have reviewed within a reasonable period of time how that product is doing? Is that part of my job?
I'm afraid I'm going to have to answer that with it depends. And it depends because it's how much, was there a feature to that product that looked at it being over a certain period of time that was important to your assessment as to recommend it to your client. I think there's an obligation to follow up there, and whether or not, you're getting now into the question of, is there ongoing suitability assessment by an EMD for their clients? And again, to me, the answer to that one is it depends on the relationship that the EMD has with the client. If it's an ongoing one, as in the traditional retail-oriented environment, then I think you have different obligations to assess suitability on an ongoing basis, and one of those may be, what is that product doing now? But also, obviously when that client comes back to you and says, I want to get rid of this now, I want to buy more of it now, your obligation arises again there. So I think you have to look at that on a case-by-case basis. What is the product? What are the features of the product? Was it dependent on it being there for 5 years? Is there a conversion feature? Is there some rollover feature?
So let me change the facts just a bit. You don't get a call from them. You decide that you want to monitor that company, and you decide, and you find out that they're engaging in practices that you think, had you known it before, would have led to you not recommending it to anybody. So it's not about that in particular client, it's about the product itself. Other than your moral responsibility and your business responsibility, do you have a statutory or regulatory responsibility to pick up the phone and call everyone and say, had I known then what I know now, I would not have recommended this product, govern yourself accordingly?
I don't think there's a statutory responsibility on that one.
You always have the duty to deal honestly, fairly, and in good faith. I think to the extent the person continues to be a client and you are proposing to make sort of further recommendations about the client's portfolio, I think you need to have a good understanding of what's in that portfolio. And if you now know something about a product that you previously recommended, I think you have to fess up.
Okay, so here's another. So you decide that that's the case, and you keep dealing with one client, but not client A, but not client B. So client A calls you and says, I want to double down, and you say, maybe you should go to zero. Do you have a responsibility to have a blast to all of your clients who were involved in that, because you want to ensure that you don't give anyone an advantage over anyone else? And if you happen to know that the liquidity of a certain product is based to 5% of the outstanding units in a given month, and you know that that first client's going to represent those 5%, are you involved in some sort of, wittingly or unwittingly, in front running?
Yeah, I just want to add some color here. There's a concept called reasonable client expectation. So basically, if you are a dealer selling a product and you're not taking care of the client's holistic needs, in other words, you're not sitting down and talking about their retirement plans and doing a full financial plan for them, then the question is it reasonable that you will keep monitoring this product forever? And that's really something that is unfortunately not defined in regulation. It's defined by the courts. So, which doesn't get us anywhere. But I think the reality is that if you were putting a product in your shelf, you're basically saying that I'm aligning my reputation with this product. And so it makes sense that you keep a close eye on the issuer and a close eye on the financial offering. And if you see that there are problems, you certainly don't want to have issues down the road in the form of complaints or legal actions against you. So I think it goes beyond that. I think it's just good business sense. When you sell someone a product, you sort of keep an eye on it. And if you realize that what you've sold them isn't what you thought you'd sold them, that you take appropriate action.
And what if you're an issuer EMD? So now you discover that what you thought was liquid isn't so liquid, which makes it unsuitable for certain people, but perfectly suitable for others to whom liquidity was not a big issue, but you aren't allowed to engage in selective disclosure.
Yeah, so that's usually where you have a restriction of redemptions. But that's normally disclosed in the there's another concept that when you make a sale of suitability, it's got to be based on information that you can reasonably know at the time. Now, the LOC doesn't expect you to be a fortune teller. So if you think there's an outlier chance that you may need to stop redemptions on the fund, and you've disclosed that in your OM, and you've told your clients, which you should, because you want to give a balanced presentation when you're making recommendations, then I think if that situation happens, then I think that's my view is that should be fine. You can always get a sympathetic judge that would rule for the little old lady that you sold the product to, but I think from a business and logical perspective.
Before we open it up to the audience, because I'm sure there might be some questions because it's such a great panel, I just want to turn just for a minute back to this concept of suitability versus fiduciary duty or best interest of the client, because it's something, of course, that is sort of at the heart of that decision-making process. Is something suitable if you know that it could be had more cheaply or in a better format for the client, does it stop that the boots fit, or does it matter that the boots are on sale the next day? Where does that line stop? Anyone?
If you're talking about a product that's, you're talking about two different products on your shelf?
No, let's say I have a product that is available in some sort of a low load or a no load, and I'm not all that I'm certainly going to disclose that the low load is X%, but I'm not necessarily all that inclined to verify the existence that there's a no load version. Do I need to?
I would say yes. You have to deal honestly, fairly, and in good faith with your client. So if you have that product, or that product's available to you, dealing honestly, fairly, and in good faith, and I would say that that's something you would probably have to do.
I would say it's a false question. It's like Economics 100 back in university, where they say if you keep all things standard, then this should happen. But as soon as you hit the real world, keeping all things standard is a fiction. The reality is that every product is unique. There's lots of features to it. Whether you're investing in real estate in Alberta or Ontario or Calgary or Edmonton, they're all unique. The features are unique as well. So I don't think that you can be cornered into saying, well, our product is number 2 to every other product out there. So I think that's a false equivalency. And if you have a product that you think is inferior, then don't sell it. You want to sell the best products that are on the shelf. You want to design the best offerings that are out there.
And Marsha, you would deal not only in the EMDA space. Is it fair that EMDs have a significantly higher disclosure requirement than IROC dealers in a lot of cases?
Well, I'm not entirely sure they do in reality. IROC rules, as we know, are going to conform to the CSA rules, as indicated in the CSA notice, and IROC dealer members have KYC, KYP, suitability obligations. Is it a specific type you're looking at, or
just between us? It may be that IROC dealers don't run to the phone to let their clients know about the commission on the sale of a closed-end fund at the offering, for example. In fact, I'd say that none of them do. I'd say that there are very few who are also insurance licensed who reveal the existence of, forget about the amount of, the commissions in the sale of insurance. And yet, I'm not suggesting that EMDs shouldn't have this requirement, but is it fair that we all have this requirement, which is way up here, when you can go buy $1 billion of penny stock without having a whole bunch of the issues down there?
I have a real problem with that.
Does anyone find that unfair? Okay, I just want to make sure that I'm not, sorry? Just a little bit, okay. So let's open it up to the floor, because we have enough time, and I have a couple of other questions if we don't have any on the floor, but let's go over here. Sir?
I don't hear any comment or any talk about